Hey guys, Rhett here. Thanks for watching. Want to talk today about appreciation values in cheaper markets. There are a lot of misconceptions out there about getting into long-term hold rental properties, Section 8 rental properties, what have you, and weighing what is more important. High yield cash flow, high yield returns versus appreciation values. Now, there are some people that love to invest in areas that are going to appreciate a ton. Of course, that's what we all should want to do. But a lot of times when we get into some of these markets that have a lot cheaper entry-level prices and a lot lower acquisition costs, there has to be some kind of trade-off, right? If we look at some of these markets where we can buy property for $20,000, $30,000, $40,000 a house, there has to be trade-off. Otherwise, every single person in the world would be wanting to do this. You know what I mean? So what exactly is it that we're trading, and is the trade-off worth it? Now, I talk to my clients all the time, members of those in my coaching program, about trying to make as much money on our cash as possible. When we invest in property, we want to try and make as high of a return as we possibly can. And you guys should want to do that with every investment that you get into. Now, in some of these markets, we want to make sure that our yield, our cash flow return is incredibly high. And what do I mean by that? Usually, I don't let my clients get into anything under 10% cash on cash return. Usually, though, we're closer to between 15 and 25%. Okay? The reason being is because we are sacrificing appreciation over the long term for high yield cash flow, right? When you take appreciation, what are we assuming? We're assuming two things. One, the real estate market's going to keep doing this. And that's number one. Number two, with appreciation, those who focus more on appreciation can be less focused on cash flow. What do I mean by that? Well, if we buy a place in New York City today, we're assuming that, okay, whether we buy a single home and rent it out in New York City, or whether we buy a small apartment building and rent 10 units out, the odds are it's going to be so expensive for us to buy it, we're probably not going to be making too much money after all of our rent comes in versus what we're paying for a mortgage every single month. So we're hoping that 10 years from now, 20 years from now, that place we buy in New York City is worth $1 million more, and then we can basically sell that property and make $1 million, okay? Now, that is not the case when we buy in some of these areas that have lower acquisition costs. Now, what are some of the bonuses to areas that are cheaper markets where we can get into properties for less? Number one, we can get into them for less. They're cheaper. They're easier for us to buy into. There are more that we can buy in the first place. What else? Well, very high Section 8 demand in a lot of these areas, which is also phenomenal for us, because if we're wanting to get into Section 8, we want to get into areas where there is a very high demand, okay? And sometimes in these areas where there is a high demand for Section 8 housing, there is a really low supply of housing, okay? That's huge for us. It's incredibly important. Something else that we also need to consider too is when we're buying property that are in some of these cheaper markets, we're not going to get the appreciation, so we have to make up for that with cash flow. If we buy a property for $50,000 and we put 20% down, we're into it out of our pocket for $10,000 our down payment, right? $50,000 purchase price, 20% of that's $10,000. Say we put $5,000 into it for rehab, we're all into it for $15,000. We rent that property out for $1,000 a month. Every month, our mortgage on it's $400. And look, we're net cash flowing $6,000 a year, right? $600 a month net. It's actually more than that. It's actually over $7,000, $7,200 per year, okay? So that is what we're doing. We're making a high yield return on our initial investment of cash, which was $15,000. If 20 years from now, you only are able to sell the property for $50,000, what you bought it for, We have to make sure that over that time frame, we're still making plenty of money. Now, that cash on cash return example, that's actually an example from one of my clients just had a couple months ago. And that's insane. I mean, that's almost a 50% cash on cash return. It's about 43, 44%. That's realistic. I mean, those are numbers that are, legitimate numbers, and those are attainable for a lot of you guys watching this video. But my point is, we are trading appreciation for cash flow. We're trading that 40%, and granted that those numbers are high. That's a high example that I gave, but still, we're trading in the appreciation on that property over the next 10, 20 years for that extremely high cash on cash return that'll put us in the green in a little over 2 years. That's what we're trading, okay? We're trading realized money, okay, versus an unrealized gain of appreciation. Playing the appreciation game over time is fine, but it's not going to make you a lot of money in the short term. It's also not going to help you supplement your life. Financial freedom won't be achieved for you guys when you're looking at appreciation until you sell the property. I want to make sure that property that you guys get into, you're receiving dividends, you're receiving cash from that every single month. I want to make sure you guys are making money every single month. I don't want you to, be hurting and say, well, damn, I wish I was making more money on this, but 7 years from now when we sell it, it'll be ready to go. An issue with looking at the appreciation model is you're also assuming that when you sell the property, we're going to be in a phenomenal real estate market, right? Imagine you buy a property in 1999 and you say, okay, I'm going to hold this property for 10 years. I'll buy it for $100,000, and 10 years from now, it'll be worth $300,000. Guess what? If you bought a property in 1999 and you went to sell it in 2009, you probably would have lost 70% on it, okay? So if you had bought it in 1999 and decided to cash flow it for 10 years, you'd be in the green, okay? So there's just a lot of speculation when we buy and we're trying to focus on purely appreciation. We've got to make sure, guys, I did a video about 2 weeks ago, a week and a half ago, about making money. How do we make more money? We have to be netting cash every single month. It's so important. I want you guys who are thinking about buying property for appreciation to think about the big picture. The last 3 years have been insane. You buy a property for $100,000 and you sell it now, 3 years later for $260,000. That's not how things are, guys. There's significant ebbs and flows in every kind of real estate market, but it's important to know that playing appreciation is just the cherry on top, okay? Appreciation for my clients, appreciation for me is just something that comes with the strong cash flow, okay? It just comes with it. It's an added bonus, right? We don't want to put all of our eggs in the appreciation basket, because if we need to sell that for something, there's never going to be a guarantee that it's going to be for significantly more money than you bought it for. And the reality is, guys, even properties that you buy in lower income markets, in cheaper markets, there's still going to be some appreciation. It's not going to be drastic. It might be 1%, 2%, 3% per year, which will be significantly lower than other markets across the country, but it's still something, okay? It's still something. Focus on cash flow, focus on monthly net, and then 10 years from now, you won't even have to worry about what it's worth, because you would have already made your money back well before then, okay? Guys, drop your questions and comments below. I'll get to every single one of them. We'll see you next time.